March 10th, 2023, 11:11 in the morning. California regulators walked into the offices of Silicon Valley Bank and seized it. The entire process took less time than a lunch break. In the 48 hours before that moment, customers had tried to withdraw $142 billion, 81% of the bank's entire deposit base, in what the Federal Reserve's own vice chair called an unprecedented bank run. The fastest in American history. And here's the detail that should stop you cold. The day before the run started, California regulators had officially described SVB as being in, quote, sound financial condition. So here's the question this video is going to answer, not what happened to SVB, everyone has covered that. But why the people running this bank, following every standard rule in the textbook, made the exact decisions that guaranteed its collapse. Because it wasn't greed, it wasn't fraud, it wasn't incompetence, it was competence, and that is a far more terrifying story. By the end of this video, you're going to understand something that most financial journalists never fully explain. The specific three-layer mechanism, not the story, the actual mechanism, that made SVB's collapse not just possible, but almost mathematically inevitable the moment certain conditions were met. And once you understand it, you'll see it isn't unique to SVB. The same structure exists at banks right now today. Some of them you probably use, that's not a scare tactic. The data is public, the Federal Reserve published it themselves, and I'll show you exactly what it says at the end. To understand what SVB actually was, you need to understand what Silicon Valley looked like in 2020. The pandemic hit. The Federal Reserve cut interest rates to essentially zero. Suddenly, every venture capital fund in the country had access to almost free money, and they poured it into tech startups at a pace nobody had seen before. In 2020 and 2021, VC investment in the United States more than doubled. SVB was the Bank of Silicon Valley. Founded in 1983, it had spent 4 decades building relationships with exactly the kinds of companies VCs were now flooding with cash. Airbnb banked there. Cisco, Fitbit, Pinterest, Roku kept $500 million in a single SVB account. If you were a funded startup, there was a very good chance SVB was your financial home. Here's what that meant for the balance sheet. Between March 2020 and the end of 2021, SVB's deposits didn't just grow, they exploded. From $62 billion to $189 billion, more than triple in less than 2 years. The bank was drowning in cash, and its treasury team made a decision that by the end of 2022 had turned $189 billion of deposits into a time bomb sitting inside $117 billion of long-dated government bonds. How that happened is the decision that destroyed everything, and it starts with one assumption that seemed bulletproof. Here's something that rarely gets said clearly in SVB coverage. At its peak, this bank had provided financing to nearly half of all venture-backed technology and healthcare companies in the United States. Half. That wasn't a business relationship. That was infrastructure. SVB didn't just hold startups' money, it was woven into the operational DNA of the entire innovation economy. Payroll ran through it. Options were financed through it. When your startup needed to make rent, you called SVB. And the bank's CEO, Becker, who had joined SVB as a loan officer in 1993 and worked his way to the top, was celebrated for building it. By 2021, SVB was on Forbes' list of the world's best banks. Its stock had climbed from around $100 to over $750 in 4 years. This wasn't a risky, reckless institution. By every conventional measure, it was one of the best managed banks in America for its niche. That detail matters, because what's coming next only makes sense if you understand just how competent this operation looked from the outside. So what did they do with $189 billion in deposits in a zero interest rate world? They did exactly what the textbook said to do. They bought US Treasury bonds and government-backed mortgage securities, the safest assets a bank can hold. AAA rated, backed by the full faith and credit of the United States government. By the end of 2022, SVB held $117 billion in bonds, over 55% of its entire asset base, in what the entire financial world considers risk-free paper. The problem wasn't what they bought, the problem was how long those bonds would take to pay back. Here's the thing, from inside the room, this made perfect sense. When SVB's treasury team surveyed their options in 2020 and 2021, they faced a blunt problem. Interest rates were near zero, which meant short-term bonds paid almost nothing. But longer-dated bonds, 10-year treasuries, 30-year mortgage-backed securities were paying meaningfully more. On the $100 billion in deposits, even 0.5% more yield is $500 million extra dollars a year in revenue. So they went long. They bought bonds that wouldn't mature for years, sometimes decades. They booked them under a classification called held to maturity, which under accounting rules meant the daily market price of those bonds simply did not matter. As long as SVB held them to their maturity date, they would get every dollar back. On paper, the position was clean. The logic was textbook. Buy safe assets, earn a reasonable yield, hold to maturity, every dollar accounted for. But buried inside that logic was an assumption. And here's what they couldn't see. The assumption wasn't about bonds. It was about deposits. SVB had implicitly assumed that the money in customer accounts would behave like stable long-term deposits. That's normally safe. In most banks, deposits are sticky. People don't move their money often, even in uncertainty. But SVB's depositors were not normal. According to the Federal Reserve's own post-mortem, approximately 94% of SVB's deposits were above the $250,000 FDIC insurance limit, meaning they were uninsured and fully exposed. SVB's own filings estimated the figure at 86%. And that discrepancy alone tells you something. Even internally, nobody had a clear grip on the true scale of the vulnerability, and its customer base was a tiny, hyper-connected community. Startup founders, VCs, tech executives, people who all talk to each other in the same group chats, at the same conferences, on the same corner of Twitter. The bank was assuming its deposits were like concrete. In reality, they were like water in a network of open pipes. Now, there's a second layer to this, one that almost nobody covers, and it's the detail that when I first read it made the whole story feel different. In April 2022, SVB's chief risk officer, the person whose entire job was to catch exactly this kind of structural vulnerability, quietly stepped down. Her name was Laura Izurieta. She signed a separation agreement and moved into a non-executive transition role. SVB then went 8 months without a permanent replacement. 8 months. April 2022 to January 2023. The exact 8 months during which the Federal Reserve raised interest rates from 0.25% to 4.5%, the steepest tightening cycle in 4 decades. The position specifically responsible for catching the structural flaw was empty while the flaw was becoming a crisis. The bank's risk committee, clearly sensing something was wrong, more than doubled its meeting frequency, from 7 meetings in 2021 to 18 in 2022. They knew. But with no permanent CRO in place to force a decision, the concerns circled without resolution. CEO Greg Becker would later tell the Senate Banking Committee that finding the right replacement takes time, and that he'd kept Izurieta in an advisory capacity to prevent gaps. That's probably true. It's also the kind of explanation that sounds entirely reasonable, right up until the moment the building catches fire. But there's a third layer, and this one goes back 8 years before the collapse. In 2015, Greg Becker personally testified before the US Senate Banking Committee. He argued that SVB and other mid-sized banks should be exempted from Dodd-Frank's enhanced prudential standards, the safeguards put in place after 2008, which included mandatory annual stress tests designed to catch exactly the kind of interest rate exposure SVB was building. His argument was that SVB does not present systemic risks and that the regulations would stifle their ability to provide credit to clients. He won. In May 2018, Congress passed a law raising the stress testing threshold from $50 billion to $250 billion in assets. SVB had just crossed $50 billion. At the time of its collapse, it had $209 billion, safely below the new threshold and exempt from annual stress tests. The Federal Reserve's own post-mortem confirmed it directly. SVB would not have been subject to regular stress testing until 2024, 3 years after it had crossed $100 billion, 3 years in which the duration mismatch was compounding in plain sight. So let's hold all 3 failures together. The bank built a $117 billion bond portfolio on an assumption about deposit stability that was wrong for its specific customer base. The person responsible for catching that flaw left and wasn't replaced for 8 months during the steepest rate cycle in 4 decades. And the regulatory stress tests that would have flagged the problem had been successfully lobbied away by the same CEO who built the portfolio. At the time of its failure, SVB had 31 unaddressed regulatory safety and soundness findings, triple the number of comparable banks. The Federal Reserve had been raising concerns since November 2021. The bank had failed its own internal liquidity stress tests and responded not by fixing the problem, but by adjusting the assumptions in the model until the tests passed. Competence, not incompetence. The machine was running exactly as designed. The design was the problem. On March 8, 2023, SVB made one final decision that was, in isolation, financially rational. To raise cash for mounting withdrawals, the bank sold its entire available-for-sale bond portfolio, $21 billion, at a loss of $1.8 billion. Then it announced it would raise $2.25 billion in new equity to fill the gap. The announcement was designed to signal control. Instead, it broadcast distress to the one community SVB could not afford to alarm. That same evening, Moody's placed the bank under review for a potential double credit rating downgrade. Word reached venture capital firms before midnight. Founders Fund, Peter Thiel's firm, moved first. By Thursday morning, March 9th, they had pulled every dollar they held at SVB and were quietly advising portfolio companies to do the same. Their internal reasoning, reported later, was unsentimental. They expected the crisis to pass and planned to return the money once it did. They weren't trying to destroy SVB. They were being rational. That is the most disturbing detail in this entire story. The bank run that ended Silicon Valley Bank was not driven by malice. It was driven by rational self-interest from the very community the bank had spent 40 years nurturing. Within hours, Union Square Ventures, Coatue Management and Founder Collective had sent emails to their entire portfolio rosters, "Move your money now." The VC community that SVB had built alongside, the community it had financed, defended and championed for 4 decades, became the precision instrument of its destruction in less than 18 hours. By the close of business Thursday, March 9th, customers had withdrawn $42 billion. Not over a week, one day, $42 billion, which meant SVB had a negative cash balance of $958 million, which meant it could not physically process the next morning's transactions, which meant California regulators had no legal alternative, which meant at 11:11 a.m. on Friday, March 10th, it was over. The bank's 8,500 employees received their annual bonuses that same morning, hours before the government took control of the institution. 40 years, $209 billion in assets gone in 48 hours. On March 26, the FDIC announced that First Citizens Bank shares would acquire SVB's commercial banking business. First Citizens bought $72 billion of SVB's loans at a discount of $16.5 billion. The FDIC retained roughly $90 billion in securities. Every depositor was made whole, backstopped by a special assessment levied on other banks, not direct taxpayer funds, though the distinction has been debated. Becker, who had run SVB for 12 years, was removed from the board of the San Francisco Federal Reserve at 10:15 p.m. on the night of the collapse. He had sold 12,451 shares of company stock worth $3.6 million on February the 27th, 11 days before SVB's announcement, through a trading plan filed with the SEC just 31 days earlier. The SEC and Justice Department both investigated. No charges were brought. On the Monday after the collapse, the day incoming CEO Tim Mayopoulos wrote to clients trying to restore confidence. Becker and his wife were photographed walking through the streets of Lahaina wearing shorts and flip-flops at his $3.1 million townhouse in Maui. They had taken a chauffeur-driven limousine to San Francisco Airport and boarded a first-class flight to Hawaii. He later explained to the Senate that he and his wife had decided between going to family in Indiana or family in Hawaii. They chose Hawaii. His colleagues were still in California handling the fallout. SVB now operates as a division of First Citizens Bank, serving a much smaller version of its former client base. The 40-year experiment of building a bank for Silicon Valley is effectively over. But the principle this story teaches, the real one, not the headline, is something that should matter to every person watching this. There's a concept in banking called duration mismatch. The idea is simple. A bank borrows short, your deposits, which you can pull out any time, and invests long, in assets that take years to mature. The gap between those two time horizons is the mismatch. Every bank operates with some version of it. It's not a bug. It's the core of how banking works. What SVB did, and this is what I said at the opening, is that they made this mismatch far larger than usual, not out of recklessness, but out of competence. They found the highest yielding safe assets available in a zero-rate environment and deployed capital exactly as a skilled treasury desk should. They then lobbied away the regulatory check that would have caught the exposure. They then lost the internal voice that might have forced a correction. And they operated under an assumption about deposit stability that was correct for every other bank in America, but catastrophically wrong for theirs. What killed SVB wasn't a bad decision. It was a correct decision made inside a model built on 3 flawed assumptions, deployed in an environment that model had never been stress-tested against. And not one external party, not the board, not the regulators, not the auditors at KPMG who signed off on the books, not the Federal Reserve supervisors who had issued 31 warnings, turned that into a full stop before March 8th. SVB was not a uniquely bad bank. It was the most visible bank when the tide went out. And here is what should make you genuinely uneasy. At the height of 2022, the Federal Reserve's own data showed that unrealized losses across the entire US banking system on held-to-maturity securities exceeded $620 billion, not SVB, the whole system. The duration mismatch didn't disappear when SVB did. It moved. Some of it is still sitting on balance sheets right now. If this story stayed with you, I want you to watch my video on how Lehman Brothers built a structurally identical logic in 2008. Different instrument, different trigger, same failure mode. The moment you see the parallel, you won't be able to unsee it. But here is the question I want to leave you with. Right now, in 2025, the Federal Reserve has been holding rates at elevated levels for longer than most models assumed. There are regional banks still carrying unrealized losses on long-duration bonds, the same instrument that destroyed SVB. Which bank do you think is carrying the most dangerous version of that mismatch today? And what specific trigger do you think would turn it into a run? Leave your answer below. I read every comment and I'll pin the ones I think are right.